Good afternoon, ladies and gentlemen, and welcome back to Foord's Meet the Team event for unit trust investors. I hope everyone is well and in good spirits, and I look forward to catching up with as many of you as possible at the break. I'd like to start by thanking you for your ongoing trust and support. We know that you have choice, in fact, more choice today than ever before. Last week, I counted the number of asset management brands offering unit trusts in South Africa. And can you possibly guess how many there are? 50? Maybe there's 100? Actually, there are more than 300 asset management brands offering more than 1,700 unit trusts in South Africa. Brands from 10X, 361, and 274, from ABAX, Alan Gray, and Alexander Forbes, right the way to Visio, Vernani, and Woodford. Now, each of these brands is trying to differentiate themselves in a hyper-competitive and overcrowded market. Amongst the noise, I think Foord's pedigree is rare, 43 years of unbroken investment stewardship. Now, our value proposition is one of risk management and safety-first investment. We don't chase rainbows with client money. Instead, we make high-conviction, long-term investments only when the risk-reward trade-off is stacked heavily in our favor. Now, the market doesn't always agree with us, and if you think about it, prices on bond and share markets are set by the marginal buyer and seller, often transacting for very short-term reasons that are unrelated to valuation. And as a result, we can end up with some performance variance from time to time, and which can extend for a while, but it also throws up some enticing investment opportunities for the more patient investor. So for those of you who don't know me, my name is Paul Kluwer. I'm Managing Director at Foord, and last year's speakers Mike Townshend and Linda Eedes joined me again. Now, if you were here last year, you'll remember that we spoke about how the world hadn't seen an interest rate-induced global recession for 15 years, not since the global financial crisis. And our minds were very much focused on the risk to investment portfolios if the vast US economy were to tip into recession after having endured the fastest interest rate hiking cycle and the steepest in more than 40 years. Now, in the event, while some European economies flirted with recession, the US economy was very resilient in the face of higher interest rates, which, as Mike will show you, have peaked and are now on their way down. That said, we are seeing some slowing in the US economy, and we're seeing rising credit card and auto loan delinquencies. So the focus today is not so much on recession, although I guess one may still come to pass. But the focus will be on whether corporate earnings growth can sustain the very high valuations, especially in the US market. We're also going to look at China and put our exposures there into some context. And then Linda is going to take a deep dive into the South African share market, look at how we are investing, specifically in the Foord Equity Fund, in a very low growth environment. Okay, I'm going to jump straight into the asset class returns that give you some context for what's happened in global markets. As usual, I'm showing numbers for the year to date, 2024 to the end of October, 10 months, and the prior 2 calendar years as well, just for some context. And very briefly, you can see 2022, that was the big down year. Global share and bond markets fell heavily as central banks were forced belatedly to react by rapidly raising interest rates to combat soaring inflation. Then last year was the big up year. Markets rallied, especially on the AI theme, and quite narrowly so, but also on the prospect that the next move in interest rates would be down. The one exception was China. It fell for the 3rd year in a row on worries about the over-indebted property market and general economic malaise. And then we can see the start of the gold bull run last year as well. So that gives some context. This year, we can see global developed market share markets are up 17% in US dollars for the 10-month. Once more, they've been pulled up by US markets. They're up 20% in US dollars, quite narrowly so. They're at all-time highs. They've risen again on the tech theme, although more recently the rally has been more broad-based. Those magnificent 7 companies that we spoke about last year, that cohort is at it again. It's up 37% as a grouping, helping to pull up markets. And in fact, I think chipmaker NVIDIA, now the largest company in the world, is up 200% in this 10-month period, have contributed to those returns. Not shown here, but hidden in the numbers, is the fact that European share markets are only up 5% in US dollars. So we can see once more that the rally has not been as broad-based as one might expect. And then China, it struggled for most part of the year, and then in September, the Chinese authorities announced targeted stimulus, and the market responded. It bounced. It was up 22% in September alone, and that stimulus was significant, but not quite as much as the market had hoped for. And we've seen some retracement since then. Then on the global bond markets, down slightly for the year to date, and that's despite the first interest rates coming through in almost all developed market economies. And here investors are looking past interest rate cuts and towards the level of indebtedness in global developed markets, and they're wondering just how sustainable those debt levels are and penalizing the bond market for that. In South Africa, we can see the JSE is up as well, up 15% in rands, more so in dollars given the rand's strength against the US dollar after the formation of the GNU. Now, most of those share gains in South Africa are from the industrial and financials sectors of the JSE, and as Linda will discuss later, commodities or resources sector has lagged again for the second year, as we expected it would, and she will take you through that market in more detail. The very high yields on the South African bond market have helped that asset class to another double-digit return in the year to date, but boosted, of course, by improved political sentiment. And then to close out the asset class table, we can see that listed property rallied after many years in the doldrums. Gold was a standout performer, up 33% in the year to date. That's in dollars, on safe haven appeal, and I guess the prospect that interest rates will go even lower. Then we can see that oil was slightly lower. The rand, as I noted, was stronger against the dollar in this period, and the dollar slightly stronger than the euro. Just to note, these numbers are to the end of October. They predate the US elections. The Republicans swept those elections, and we have seen a Trump trade of sorts since then, and quite a bit of extra volatility. They're not in those numbers. But we can see that on paper, at least, the environment has been quite supportive for returns to investors. And let's have a look at see how Foord funds have done in this environment. I'm going to start with the Foord Global Funds. These are the US dollar-priced funds managed abroad. Now, last year we spoke about how the funds had underperformed benchmarks and peer groups quite heavily, and we spoke about the reasons for that at some length. There were 2 main reasons which are, I guess, important, because one of which has persisted and one of which has reversed. So briefly, share markets rallied last year on the AI tech theme. That magnificent 7 grouping of mostly US tech shares surged last year. They were up 75% as a group, and they 7-handedly pulled up global share markets. They accounted for 62% of all the gains in the US share market from those 7 companies, and they accounted for 40% of world market gains from 7 companies. So 40% of the MSCI All Country World Index, which is just an index of global share markets, and which is the benchmark of the Foord Global Equity Fund. So if you didn't hold those shares in the weights that they are in the index, you would have lagged. Then China. China has been the factor that has reversed, but it was down 13% last year when most global share markets were up by double digits. So if you had any meaningful investments in that market again, you would have lagged. So this year, we've seen one of those factors reverse and one of them be sustained. But we can see that after some very resilient performance in 2022, the Foord Global Funds lagged quite heavily last year. This year, given the AI tech theme has continued and the Chinese share market has recovered somewhat, we can see that because we are underweight the very expensive tech sector in the US, we have again lagged the MSCI All Country World Index in our Foord Global Equity Fund, but the fund has nevertheless delivered double-digit returns, 12% in US dollars, which is a pleasing outcome in the circumstances. Then the conservative Foord International Fund has been cautiously positioned for some time against a myriad of risks as we've seen them. The fund was up 5% in dollars to the end of October. And I'd just like to put that return profile into context as I did last year. So here the fund in orange, and this chart starts 31 December 2021. Why? Because that was when share markets had last reached their peak before they fell and then recovered. And we can see quite a bit of volatility from the return series that I'm showing. Let's start with the light gray line. That's the world global bond market. You can see that it fell, and it is still 15% below where it was nearly 4 years ago. If you'd invested only in bonds, you would be underwater. Global share markets in gray, the dark gray line, fell more heavily. They were down 25% at one point before rallying on the AI tech theme, and very narrowly so, to reach nearly all-time highs, and they are up 18% over this period. The Foord International Fund in orange has been managed to avoid these big price swings. It has performed much more stably, and it now performed in line with the peer group funds, so funds that have a very similar mandate and management style in blue, but you can see with much less volatility. So that fund has done its main job to protect capital in a risky environment, but we understand that given the magnitude of the share market recovery, investors would have been expecting a bit more from that fund. I'd like to just talk about our China exposures. Investments in mainland China range from 20% of our Foord Global Equity Fund down to 12% of the Foord International Fund. And for the South African multi-asset funds that you invest into, they range between 5 and 10% mandate dependent. So these are meaningful exposures, but they're certainly not all into China. And just to give that quantum some context, this is a chart of the top 10 global economies in the world using something called nominal GDP. It's measured in dollars, and it tends to favor the Western markets with hard currencies and penalize the emerging markets like China and India. But nevertheless, we can see that in gray, China is by far the world's second largest economy. It's bigger than the economies of Japan, Germany, and India put together. But with a 15% contribution to world GDP, it only comprises 2.3% of that MSCI All World Index. So if you invested in the index, you would have 2.3% of your money invested in one of the world's most attractively priced markets. Look at the United States on this basis that favors it in its own currency, 31% of economic output for the world, but look at its share of the world index, 2/3 and rising. So again, if you bought the index, you would have 67% of your money invested in a very expensively priced market, and the rest are the other economies. So actually, if you adjust for prices and you adjust for exchange rates, then the economic activity taking place in China is actually bigger than what is taking place in the USA. And we don't feel that having less than 3% in one of the biggest economies in the world makes sense. Now, this chart shows or compares the performance of the Chinese share market in orange to that of the US share market in gray. And we can see that China peaked in early 2021 when it seemed to have ironically sidestepped the very worst of the pandemic that started on its own shores. Subsequently, China locked down later, if you might recall, than the Western economies, but by which time worries about the over-indebted property development sector soured investor sentiment, and the market has fallen. We can see that it's still 40% below its peaks, and that's despite the recent rally. And most notably, a large valuation gap has emerged between the Chinese market and US share markets, which are trading at all-time highs, but not only that, right at the top of their valuation range relative to the earnings that are being produced. So in fact, US share markets are 40% more expensive than their long-term averages, and about twice as expensive as the Chinese share market, where earnings are also growing faster. So what is keeping the Chinese market depressed? Well, I think in simple terms, we can say that's sentiment. There's just not enough buyers for Chinese shares outside of China, but also inside of China. Okay, inside of China, Chinese consumers are hoarding cash because they're worried about the value of their home prices, which have fallen more than 40% since their peaks in 2021. It seems to me to mirror what's happened in the share market. And why are home prices falling? Well, there's been an oversupply of property units. And as a result, Chinese consumers are feeling less wealthy and are worried about their wealth. So they're tending to hoard cash. So an oversupply of properties is going to take some time to work its way through the system. And the Chinese authorities are actively engaged in this. And it strikes me as a problem that most Western economies wished they had, as an oversupply of homes. But forecasts had expected home prices to bottom by the end of this year before stabilizing and rising, and of course that will create a wealth effect. And the very latest data being released suggests that home prices may already be recovering, although it's still early days. I'd just like to note as well that our exposures to China are not in controversial sectors or companies. They're mostly in consumer-facing stocks, which are affected by sentiment, but which are unlikely to be affected by sanctions or tariffs. And I'll give you one example. The Foord Global Equity Fund invests in a company called Yum China, and that owns the franchise rights for KFC and Pizza Hut in China, amongst others. And interestingly, it has more than 400 million users of its KFC app. And that company, as I said, is unlikely to be hit with sanctions or tariffs. And so we continue to believe that the Chinese economy is primed for a recovery, and there are very few Western investors in that market, and when they come back, the market is likely to rally. Now, if you weren't able to attend our online webinar last week, I would urge you to listen at least to Ishrath Hassan's 10-minute segment on prospects for the Chinese economy and share market. It's a very interesting watch. All you need to do is log on to YouTube and search for Foord, How to Thrive in 2025. Okay, just turning to the performance of the Foord SA funds. This is in rands, again, to the end of October. We can see that the multi-asset funds at the top, Foord Conservative, Balanced, and Flexible, they have, for the most part, compounded double-digit returns last year and for the year to date. They're not at the top of the relative ranking tables, but that matters less to us than delivering a safe investment return to investors. The Foord Flexible Fund holds much more of its exposures offshore. It's lagged the other products, but it's also the product that's likely to benefit most from a rebound in our offshore investment thinking, and it's also the fund that protects investors most against rand depreciation, which we're seeing in November again as part of that Trump trade. The Foord Equity Fund at the bottom, I recall year after year standing up here asking for your forbearance and patience with our view there. So it's very pleasing to me personally to see that our views are being vindicated. We've some very nice outperformance against the benchmark this year, on top of outperformance last year and the year before. And in fact, over the nearly 3 years shown, the fund has added 45%. 31% of that has come in the last 12 months. How have we done it, and how are we investing there? Well, this is the meat of Linda's presentation, and I'm not going to steal her thunder anymore. And then on the Foord Flex Income Fund, this is our fixed income suite. We can see that the Foord Flex Income Fund, it's an income fund, an interest product, is safely delivering inflation-beating returns as we expected that it would. Just remember that 8.6 is not an annual number, it's for the 10 months. And then the Foord Bond Fund has done very nicely. It's up 13% this year and up 20% over the last 12 months. So that's it from me for the backward part of the presentation. Mike is now going to speak on the macro investing environment, how we see the risks and the opportunities, and how we're positioning our portfolios accordingly.
Good afternoon, ladies and gentlemen. I'm very impressed that so many of you made it here when we're having such glorious weather outside. And it was quite impressive driving in here and seeing that magnificent big cruise liner. And luckily, all those tourists are enjoying a beautiful day in the Cape today. Okay, so what I'm going to do is my first slide is going to be backward looking at what we spoke about last year and how our thoughts at this stage last year have actually come through in terms of reasonable performance. And you can see, first of all, that we were expecting decent returns to come through from the bond market, preferentially here in South Africa, and that certainly did come through. South African bonds doing a lot better than global bonds. South African equity values were looking appealing, and that did come through, and I think we've earned the 2 green ticks that we have in those first 2 points there. We were positioned for a bounce back in the Chinese share market. Those shares did do well, as Paul pointed out, at 18.6%, but we only give ourselves a half tick there because that's less than the all-important what the all-important S&P 500 did. We then had an exposure to gold, which obviously did very well at plus 33%, and then we increased our cash holdings and keeping that money as firepower to apply where opportunities arose, which they certainly did in the local market. So that, I think, we also deserve a tick. The last point, we've given ourselves a cross, because we were anticipating a slowdown in the United States market, which didn't really come to bear, and we had taken quite a conservative positioning in our portfolios as a result of that. So the fact that the market didn't recover, the caution with which we approached the year with regards to that market, did hold back particularly the international returns, which Paul has just spoken to now. So I think it's useful to go through a slide like this because it just tells you what we're thinking about and where we feel the best returns can be achieved in different asset classes. So we'll move directly into this slide, and this covers what we feel are the most important questions that we're pondering over for the year ahead. So first of all, is the US economy finally going to run out of steam? I have slides on each of these, so I'll just go through these quickly to start off with. Debt has been rising in most Western economies around the world. Does this actually matter? Should we worry about it? Inflation is always a big issue. How is that going to settle down? The US market has been very strong, as Paul pointed out to you. Can that be sustained? And then is the Chinese recovery going to continue? And then we always try and think where there can be surprises that could put our thoughts at risk and where we could potentially have significant events that might affect the value of your investments with us. And then I'll just finish off with just taking all of this and putting it together and how we are positioned given the answer to many of these important questions. So the first one is, will the US economy finally run out of steam? So what the orange line shows you is the US GDP growth. And this shows you the extent to which that economy has grown every year, and the slide goes back to 1990. What stands out for me are these 2 dips that we saw here. The GFC in 2008, where there was a real risk that the US banking system was going to collapse, and growth stopped, came to a halt essentially thereafter. And the second drawdown was here in the COVID collapse when economies around the world shut down as well. But apart from those 2 occurrences, there was pretty steady growth of 2 and even as high as 5% for most of this 34-year period in the US. A strong period for growth in that economy. Now what the black line shows you is the interest rates. And this, you can see we've had a long period of very low interest rates in the US, but what happens after we've had a period of strong growth is that the central banks actually raise interest rates in trying to slow down the economy, get inflation under control, and bring things back to more normalized levels again. But there's always a lag between when those interest rates are raised and when the economy contracts thereafter. And I think that's quite clear there. We raised interest rates here before the economy slowed down. But then look at the most recent figures that we have there. And you can see, Paul mentioned this earlier, that interest rates were raised really aggressively at the back end of 2021, and the economy did start slowing down, but and the most recent numbers were in quarter 3, where the growth rate slowed down to 2.8%. So still decent growth that we're seeing in the US. But can this be sustained? So we know that the Tangerine Man is won the election yet again, and he is determined to get growth in that economy. But look at the deck of hands that he's been given this time around compared to back in 2016. And you can see quite clearly it's a very different situation. So the S&P 500 is up almost 3 times over that time period. The PE ratio, which I'll come to a little bit later again, is significantly higher than what it was. The median house price, compared to what we saw in China, where they're down 40%, is up close to 80% over this 8-year period. I'll come back to the deficit. But inflation rates are high, and the interest rates are quite high at 4.75%. So there is scope for him to continue to influence those and perhaps get growth from that area. But what he also wants to do is cut the tax rates. And that often is stimulatory to economic growth. But look how much lower those tax rates are compared to 8 years ago. So there's just less impact that any tax cuts might have going forward. And then we spoke about the deficits, this number here, which I've got another slide on this. At minus 6.3%, that is quite a big number, and it is a bit concerning. So what that also means is that he has less firepower to stimulate the economy going forward. And I think that leads directly into this next slide, which is an interesting one to work through. This just shows you the annual, well, it's on a quarterly basis, the US federal budget deficits. So what this means is the amount of money that they spend compared to what they take in as tax and other forms of government revenue. And they've steadily spent more than what they've taken in. But there were 2 big jumps. The first was the GFC, where they really tried to stimulate the economy to get the support in for the banks in that crisis. Then we had the COVID collapse, where the US consumer was under huge pressure in particular. And so, again, they pumped more money into the economy to try and get growth going and to support the consumer. What's interesting about these points is that they spent a lot and then they struggled to rein back their spending shortly thereafter. And look at those numbers now. This year, the US government is going to run a deficit of close to $2 trillion. I mean, it's extraordinary just trying to comprehend the magnitude of that number. And so it just restricts the amount of firepower that the government has to stimulate growth going forward. And what is the other impact of these deficits and the debt that the government has been running up over the last few years? Just look at that blue line. As a result of the higher interest rates and of the increasing debt that the government has, the interest cost of servicing that debt has just skyrocketed. And it's risen by 3-fold just over the past couple of years. And that number is close to $900 billion just to service their debt, just to pay the interest on their bonds. But the other interesting thing is that now you're spending money on repaying the debt, you can't spend it in other areas. And the black line that I've put up here is the amount of money that they're spending on defense. And just given the amount of geopolitical risk that we have in the world at the moment, you just wonder whether that is an appropriate policy or have to be forced to spend so much on repaying your debt. Then we look at inflation. And it's always useful to look at inflation because this determines where interest rates are going to go, and then interest rates are big input into how we value virtually all asset classes. The income stream that you might receive from a property, the dividends that you receive from equity, the interest that you receive on bonds. The value of all of those is impacted if interest rates start rising. So you can see over this 10-year period, we had pretty benign inflation, quite a Goldilocks scenario for the first 10-year period. Then COVID hit. And the government, as I showed earlier, pumped a lot of money into those various economies around the world, and inflation shot up from 2% to 10%. They then started raising interest rates again to slow down those economies as they bounce back post-COVID, and the global inflation rate has come down, but it's still over 4%. And the conventional expectation at the moment is that central banks are going to continue to cut interest rates because they're still quite high compared to the norm, which I showed you in that table with that horrible profile of Trump in the background. And this just means that that's probably going to stimulate the economy to a certain extent. So it's going to be difficult to control inflation. And we're starting to worry now that this inflationary shark is just circling around and getting closer and closer. Another thing that Trump has spoken about is that he didn't succeed in building the wall last time around. Now, not only does he want to build that wall, but he wants to send all those immigrants back to where they came from. But look at this chart. There has been a significant increase in immigrants coming into America over the last 5 years. That's 10 million who have come into the country. But has this necessarily been a bad thing? And you look at the fact that what's in the box on the right-hand side there is that we've had a period of strong growth. When you have growth, you need to employ people. And 88% of the new jobs that have been created in the US economy have been filled by immigrants. That's an extraordinary number. And that also brings up a bit of a conundrum. Because yes, if there weren't all these immigrants, the wage rates of the US blue-collar worker would have moved upwards. And those are the people who've tended to start voting Republican in this last election. And so they, in essence, are Trump supporters. But with those higher wage rates, it would have had a big impact on inflation as well. So inflation would have moved up. And now if he is successful in sending all these people home again, you are going to see wage rates rise, and that is going to impact inflation. And then the other thing that Trump wants to do is that he wants to increase tariffs. Now, in our mind, tariffs are very inflationary as well. If a lot of goods are imported into the US, things such as their iPhones, solar panels, they import a lot from both Canada and Mexico, who he also wants to put onto that list of tariff barriers. Now, the goods that are coming into the country are then going to be more expensive. And then that will also have an impact on inflation because you've got to pay more for every item, well, not every item, but those items that are imported into the economy. Now, Paul showed you that chart earlier. We focused on the US economy because it is by far the largest economy in the world at over 30%. The whole of Europe is smaller than the US economy. And then, as Paul mentioned, the Chinese economy is behind that as well. So it's important that we understand the US economy in trying to set the scene for what global growth is going to be. Okay, so inflation, we're concerned that it is going to start rising going forward. We've got the government deficits that are here that are inflationary. We've got this feeling that interest rates might continue being cut by the central banks around the world. That's also inflationary. I've just discussed the trade wars, and then wage rates, those could start rising going forward. So this inflation shock is starting to narrow around, circle around the consumer a lot more closely. It's a real risk. Paul showed a different version of this slide a little bit earlier. He just showed the share price performance. What this shows you is the PE ratio. Now, that is a term we use in investments. The PE is the price divided by the earnings of a company. Now, when this ratio is very high, it means that the market is expensive. Now, this is a 20-year period. You can see apart from that COVID aberration where companies' earnings were affected quite severely by the lockdown, this is the highest PE ratio that the US market has been at by a long way for the past 20 years. It is looking expensive. And then what I have in orange there is the PE ratio of the Chinese market, which you can see is almost half what the US market is trading at. So many of the companies that we look at on the Chinese market are as good quality as many of the US equivalents. They are growing earnings at slightly higher rates, and yet they are trading on these significantly lower multiples. And they have more cash on their balance sheets. So we are seeing opportunities in equities around the world, less so in the all-important US market. And then let's look at China. I just have this one slide on China, and there is always risk associated with China. But I think what the government there is wanting to do is transition that economy away from an infrastructure-led growth path to stimulating other parts of the economy. And they've been very successful in that regard. So just think of items like electric vehicles. They now produce more electric vehicles than what Tesla does. The overall vehicle industry in China is significantly larger than any other motor vehicle manufacturing center in the world, including Europe, which has so many big, strong brands in it. They export 80% of the world's solar panels, 80% of the world's turbines. They're moving into high technology areas such as aerospace as well, and they're even starting to produce aeroplanes that they're using domestically now. So they are transitioning that economy into more high-tech areas, and this is shown to a certain extent in this slide. So Paul showed you what the house prices have been doing, and the orange shows you that loans to the property market have dropped off significantly over the last couple of years. And this has affected the Chinese consumer, who doesn't have that wealth effect any longer because so much of their wealth is tied up into the property market. But offsetting that has been this big increase into the manufacturing or industrial sector. So that transition is happening. The consumer is an important part of it as well. The consumer is not feeling in a good space at the moment, but inevitably that growth in the other areas will continue, and they're becoming leaders in those fields. And so we feel that the greater growth rates in China can be sustained going forward. So we're comfortable to have some exposure to that market. Okay, where can unexpected surprises come from? And I've taken these from the front pages of The Economist over the last year. It's always interesting to look at their front pages and see how sort of big financial trends are happening during the year. And we've obviously got the wars that are going on in the Middle East and then also in Ukraine. And then we have Trump, who is a little bit unpredictable and often makes statements a lot more vociferously than necessarily what he's going to implement. But there is a lot of uncertainty around what policies he might take and implement. How we're combating that last one is by analyzing quite closely the appointments that he's making at the moment. And it's important in our minds, it's quite important to try and understand that, what their histories are, what sort of thoughts they've written about in the past, and whether they might moderate some of what his statements might be, or whether they're going to just be yes men and implement strongly what he's promised to his voters. So in this sort of environment where there is always uncertainty, gold continues to play its part in the portfolio. And this slide here just shows you how extraordinarily well gold has done over the last 10 years. It's almost trebled over this time horizon. And this is the Rand gold price. And we still continue to hold gold as a hedge to macro environment uncertainty, geopolitical uncertainty around the world. So let's go through this slide and just discuss how we feel we should be positioned, given all of what I've discussed so far. So the important point, I think, is that inflation, we feel there's a real risk that inflation is going to be higher than expected. So we need to invest in assets that will hold their value in an inflationary environment. And equities, where companies can grow their earnings and often grow them faster than inflation, if not significantly more than that, and that's where you can find protection. So we have a decent weight in equities in our portfolio, but less so in America, as I've discussed. South African markets are less attractive than what they were, just given the strong run-up that we've seen in them. But I'll leave that up to Linda, who's going to discuss that in more detail shortly. And we see there is a place for bonds. We have a moderate allocation to bonds, but we see better prospects in cash, particularly here in South Africa, where you can get interest well above the inflation rate. And then inflation linkers, inflation-protected bonds, where your interest receipts will rise as the inflation rate rises. So we do have some exposure there. And then we continue to have gold. Which brings me to my last slide. And I'm just going to show you how the Foord Flexible Fund is positioned at the moment. And we've chosen to highlight this fund because it basically reflects our best investment view within the organization. We have very few constraints on this fund. We can invest wherever we see the best opportunities around the world, and so it reflects all that I've discussed so far. And you can see, it doesn't show you the last year's positioning, but last year we had 16% in cash. That has dropped. As we've seen opportunities, we've applied that to the equity market. We've also cut our weight to bonds, particularly South African bonds. And that, what we've taken away from those two asset classes, we've put largely into the equity market, and with a strong weight to foreign equities, as you can see here. And then we have that little exposure to gold. So we're confident that this portfolio should be able to deliver if inflation is higher than expected and deliver inflation-beating returns going forward. I'm now going to hand over to Linda, who will talk about the prospects of the South African market, what's worked for us, and what landmines we have to avoid in investing in our domestic market.
Good afternoon, everyone. I'm Linda Eedes, and I firstly just wanted to thank everyone for joining us here today. I'm going to start by outlining a global problem. Did you know that there are 110 million unexploded landmines sitting in 60 countries around the world? A fifth of them are actually sitting in Egypt, but they're also sitting in countries like China, Cambodia, Iran, Iraq, Angola, and even closer to home in Mozambique. Now, the problem is that it costs $3 to actually put a landmine down, but it costs $300 to actually clear one. If we carry on clearing landmines at the current rate, that's just the landmines which are in the ground today, it's going to take us another 1,100 years to do that. So this is a major, major problem. And I thought this was a good analogy for investing in the South African equity market. Because to do that, you've had to avoid some significant landmines, and we continue to have to do that. We've had to face some significant curveballs. Management teams have had to do a lot of dodging and swimming against the tide. And of course, there are two parts to actually managing investments. There's protecting capital, which is avoiding those disasters where you can actually destroy capital. And then there's growing capital, where you've got to find the best opportunities within a very tricky landscape. So let's take a look at how the South African equity market has performed. Now, here I'm showing you the price-to-earnings ratio, which Paul explained earlier on, which is basically the price, in this case, of all the mid-cap companies in the South African market. Why have we focused on those companies? Because those are the companies which are predominantly focused on the domestic economy. So that strips out a lot of the large cap companies, which are more global in nature. And we're comparing that to the underlying earnings of all those companies. And you can see that up until very recently, the prices were incredibly low relative to those underlying earnings. And what does that reflect? It reflects that everyone was very, very pessimistic about the situation that we were facing. Of course, one of the advantages about everyone being excessively pessimistic is that you just need one thing or two things to move in the right direction for people to start improving their perception of how things might play out. And the big mover for us was, of course, the formation of the GNU after the elections this year. And you can see that the market significantly re-rated relative to those underlying earnings. And it's gone from being excessively cheap, although having said that, it did get cheaper before it re-rated, to being somewhat in line with its long-term average if you actually look at that price-to-earnings ratio over its history. Now, against that backdrop, I'm very pleased to tell you that the Foord equity team has done a phenomenal job of avoiding some of the disasters and actually taking advantage of investment opportunities such that we've actually outperformed the South African market quite considerably. If you look at the year to date, this is the most expensive fee class. This is after fees. The fund is actually up more than 20%, and over the last year, that number is actually over 30%. Now, this fund, by the way, goes back more than 20 years. So we've been doing this for a very long time. But the big question on investors' minds is where to from here? Is there more value to be unlocked? And how do we do that? How does Foord do that in order to actually protect and grow capital and continue to deliver good outcomes for our investors? So the first question is, how is the GNU performing? Because if that was the major catalyst for investor confidence rising, we've got to ask ourselves the question, are things moving in the right direction? Well, voters seem to think so. This is poll results in the black bar compared to the May election results for all the underlying parties stated here. And you can see that for the parties which are involved in the coalition, including the ANC and the DA, and you can see further on the IFP and the PA, investor confidence has actually improved. So voters have actually given a thumbs up that things are moving in the right direction. And for parties which are excluded, such as the EFF and the MK, the voter confidence has actually gone down. And this, by the way, are poll results from the SRF, which was one of the few organizations that had the most accurate polls prior to the election results coming out. So certainly voters are giving the GNU a thumbs up. They're saying that things in their minds are moving in the right direction. However, we're still sitting with some significant problems if we look at the macroeconomic landscape. And the first is that the South African government has a very, very big debt problem. We're addicted to debt. We continue to issue more and more debt. And you can see here, this is how government debt has increased over time. And we've also put in inflation just so that you can compare that, because of course, those numbers would go up as a result of inflation anyway. But you can see that that's significantly up relative to where it should be. And the problem is if you measure that debt relative to the underlying economic growth of the country, so you look at something like debt to GDP, which is a ratio we keep our eyes on, it's gone from 35% 10 years ago to close to 75% today. Now, that number is the number at which the likes of the IMF start getting worried about whether we're starting to get into a bit of a debt trap, because we need the economy to grow in order for us to obviously be able to pay back our debt. So this is a major issue. And what do we have to show for it? Now, Mike spoke about the US. They also have a huge debt problem, but they've got something to show for it at least. Their economy has actually been incredibly robust. So we've seen economic growth actually surprising because that government debt has been, sort of deployed into assisting consumers and companies. But us, we're sitting with a very different situation. If you look at the 10-year number, we're actually sitting at less than 1% in terms of real GDP growth. So in actual fact, stripping out inflation, our economy is growing at a slower pace than our population. So on a per-person basis, South Africans are actually still getting poorer. And the growth estimates, if you look at the growth estimates from the likes of the South African Reserve Bank, are not looking particularly optimistic over the next few years. We actually need economic growth to be above 2% to actually start getting us on a more sustainable debt path. So the problems have not been solved. And one of the reasons why economic growth has been so lackluster is that capital has been sitting on the sidelines. And I'm sure many of you who have your own businesses can identify with this. It's difficult to invest in businesses, and it's difficult to actually invest in productive capacity when there is uncertainty about how things may play out. And this number over here is the gross fixed capital formation as a percentage of GDP. And we're comparing South Africa, which is the green line, sitting at 14%, to other emerging economies, such as China, which are sitting at 42%. The world average is sitting at 26%. And even developed economies, such as the US, have got a higher gross fixed capital formation as a percentage of GDP. By the way, what does that mean? Gross fixed capital formation is investment into all the productive capacity of the economy. So that's building buildings, equipments, factories, all the things which allow your economy to actually be able to grow in time. So, what does that mean as South African equity investors? It means we still have to tread carefully. We're all feeling a lot more optimistic, and that's for good reason. Things have taken a step in the right direction. The formation of the GNU is definitely a positive. But hope is not a strategy. We need to continue to evaluate the results which are actually coming through to see whether structural reform is taking place, to see whether those private-public sector partnerships are actually coming through, to actually measure those to make sure that we actually are on a sustainable economic growth path. We've still got very high levels of government debt that remains a concern, and our infrastructure problems still need solving. Although Eskom, we've had less load shedding, we can see that the proposed tariff increases suggest that Eskom is in a very, very bad state from a financial perspective. We know that Transnet continues to be a disaster. So we have not solved our infrastructure problems, which are part of the reason why that productive capacity is not being invested in. Prospects have improved, but ultimately we need economic growth if we are to have a tide that lifts all boats. So we're not going to have a tide that lifts all boats anytime soon, which means that we have to be very selective about the types of businesses that we invest in and the types of businesses that we don't invest in. So let's go back to our original problem. Now, dogs have actually been the animals that over history have been used to detect landmines. They've obviously got a very keen sense of smell. But more latterly, this little guy has overtaken in terms of the success. Now, this is the African giant pouched rat. Comes from Tanzania, and this little guy has a name. His name is Makawa, and he's in fact the most successful animal in detecting landmines in history. He's actually managed to clear more than 21 football fields of landmines during his career, and that was predominantly in Cambodia. So, how do we be like Makawa and manage to detect the landmines? Now, the reason, by the way, that this little animal is so successful, he's about the size of a dussie. He's big enough to put on a leash, because you obviously have to keep track of them, but he's small enough that he doesn't actually detonate the landmines. So, one of the ways that we do that is that we have the full opportunity set to invest in. Now, we are a medium-sized asset manager, which obviously does manage sizable assets, but we're not the largest asset managers in South Africa. And one of the significant advantages for our investors of that is that we have a wider opportunity set to find the best opportunities. Here we compare the percentage of the Foord equity fund in large cap stocks, and that's the top 40, the biggest 40 companies in the JSE, compared to the market, which as you can see is predominantly large cap companies. And it shows how much we have in mid and small cap companies relative to the index. So it shows not only that we have the ability to invest in a wider opportunity set, but also a willingness and a flexibility to do so. And those two things are really important. And it's important now because the large cap companies are the ones that re-rated so quickly. Because, of course, those are the ones that are the most liquid and the most accessible to any manager, no matter how large their size. So the first thing that we hold dear is the fact that we are able to make use of and willing to make use of the full opportunity set. And I'm going to outline for you two mid-cap examples of spectacular companies which we've been able to invest in, which have delivered very, very good returns for our investors. The second thing is that we are willing to move quickly. We are nimble, and we are actually able to move quickly. And what this does is compares the position as at the beginning of this year in these various categories and as at the end of October. And you'll see that the most meaningful change is an increase in our SA Inc. That's just a little nickname that we have for all the domestically focused businesses in our portfolio, which benefit from, SA Inc. And you can see that we reduced our cash and gold exposure quite materially. That's mostly cash. We have a very small gold position of 1.5% there. And we also reduced our exposure to some of the big multinational companies which are in our portfolio. So once we saw that the GNU was actually coming to pass, we spent a lot of time doing political analysis. We actually brought in independent political analysts to understand how that was moving. And we were actually able to move ahead of the market into some of those significant opportunities. Now, here's one of the mid-cap companies that we have in the portfolio, which has been a great opportunity. This is Premier Group. Now, you might not recognize that name, but you will certainly recognize the brands which they have. Many brands that you will know, including Snowflake, cake flour, um, blue ribbon bread, and one of my personal favorites, Wilson's black toffees. Of course, as you get older, though, you risk losing a tooth if you have one, I've tended to find. And here we compare the revenue growth for Premier. They are the most profitable baker in South Africa, and I'm sure you know they have a lot of competition. And this is their biggest competition. Tiger Brands makes Albany bread. And you can see that these orange bars, which is Premier, show the revenue growth, the quality of that business, the quality of that management team. And they have a very strong balance sheet as well, in comparison to how their next competitor is doing. And you can see the improvement in their margins where Tiger Brands has actually had the opposite. Now, this is an opportunity that would not be available to the largest managers in any meaningful size. So, by the way, this share price is up more than 60% over the year to date, would you believe? Another mid-cap example in our portfolios is WBHO. Now, that's the construction company. I don't know if any of you have kept an eye on the news in this space, but Murray & Roberts actually filed for business rescue over the last few days. One of the themes in our portfolios is that the strongest will survive. You know, when industries and sectors go through a tough time, there is a survivorship bias that the strongest have by others leaving that market and them gaining market share as a result. And what we're demonstrating here is the pipeline that WBHO has, both on the building and civil and road and earthworks. And of course, WBHO is one of those businesses that really got involved in a lot of the infrastructure development around the energy supply by the private sector into renewable energy. So this is another example of a mid-cap opportunity which is available to us and which we've taken advantage of. And would you believe this share price is actually up over 80% over the year to date? Now, what you don't invest in is just as important, because if we say that there are landmines out there, then that must be one of the things that we think about a lot in terms of how we position our portfolios. And we still have a very low resources exposure. You'll see on the previous slide that it was 8% of the portfolio. And you can see here that the earnings of these companies have been hugely impacted by lower commodity prices globally. And you can see relative to the overall market, they've been under immense pressure. And as a result of that, there's been a significant differential in how those companies have performed relative to the overall market. And we have avoided a number of landmines. You know, when you see a number like 20% for the last year for the South African equity market, it's hard to understand that actually there were significant disasters within that. You know, that's just the top line overall return for the market at the index level. But these are some of the landmines we've avoided over the year to date and their share price performance. So what you don't invest in is absolutely critical if you are to succeed in investing in an environment which has a tricky backdrop. So we're positioned to both protect and grow capital. We've spoken a lot about our SA Inc. exposure, which makes up almost half of the fund. And you can see we still have a third in overseas companies, some of which benefit from some of the dynamics that we've outlined earlier. Obviously, Naspers is very much geared to the Chinese consumer growth story. So we continue to hold a number of businesses which are not dependent on South African economic growth coming through. So that's really important. Their revenues come from otherwhere in the world, and they actually are completely separate to the South African domestic growth story. And you can see that we hold a very low allocation to resource companies. Now, if you are a benchmark-oriented manager and you start with the index as your starting point, and then you decide how much we should or shouldn't hold, you would have up to a fifth of your portfolio in those companies which have performed so poorly over the last while. But we have a low allocation and a very, very selective allocation, and we still have some cash. And while yields are high, you know, the opportunity cost of having some cash to use to actually deploy into the opportunities as they come through is a real advantage to us, and the opportunity cost is not very high because you're getting such generous yields at this point in the interest rate cycle. So here's some of the brands that you'll recognize in each of those buckets, just to give you a little bit more idea of what companies actually make up the portfolio. And ultimately, what it comes down to is that we need to think very carefully about how to continue to deliver good investment outcomes for South African investors. We have to be nimble. We have to be able to make use of the full opportunity set. We have to find opportunities where returns are not reliant on the South African economic growth story. We invest in quality South African companies with high-grade management teams which are able to manage through difficult circumstances and also dodge curveballs along the way. And we need to be able to avoid the landmines. Now, let's go back to our little friend Magawa. Here he is with his Cambodian minder. And I'm very pleased to say that Magawa is actually recognized for his excellent work in detecting landmines. He was awarded the gold medal. Now, this is awarded by the Veterinary Association in the UK, the PDSA, and it's basically the equivalent of the George Cross. It is the highest honor that any animal can be awarded. And he was the first rodent in its 77-year history to actually be awarded the gold medal. And just as if you're interested, it's been awarded to a number of horses during the wars, dogs, of course, a few cats, and even a few pigeons. But Magawa is the first and only rat which has actually been given those honors. Sadly, Magawa died a few years ago. He died actually in 2022, but he lived to the ripe old age of 8 years, which is a really good innings for an African giant pouched rat. And I'm very pleased to say that he had a very happy retirement snacking on bananas and peanuts. So that's what we hope to do for our investors, is to take care of those problems, think very carefully about them, and continue to deliver good investment outcomes. Thank you very much.